Hello and welcome again to Piedmont Business Live. I'm your host, Ken Morris, and today we're talking to George Navarro. He is the owner of George W. Navarro CPA PC. George, thanks for being with us today.
Good morning, Ken. Thanks.
Tell me a bit about you and your business.
Well, Ken, I've been in practice as a sole practitioner since September 2001. The scope of our work is small business. We do accounting, we do taxation, we do some payroll, but by and large, what we try to do is help small businesses who have problems with their accounting records, help them put it together. If they have problems with the IRS or the state, help them resolve those tax problems. If they're being audited, help them. So we're more so the problem solvers. That's what I love to do. Help a company put their stuff together. Maybe they didn't get the right guidance or good guidance with how to structure either their business, how to structure their accounting records, and how to then make sure that you don't have a problem, or if the problem exists, how to mitigate it going forward.
Okay. So what are some important issues to consider when you're determining what type of legal entity for tax filing?
That's a good question. Many small business owners sometimes make the mistake of choosing an entity what is right at the moment, as opposed to what would be right on a more longer term, or the possible impact on the longer term. Because initially, one of the things that we don't see enough is we see business owners come in with money. They all have money. That's never a problem. The problem is what people turn to learn too late sometimes is money is finite. Right. And the resources are finite. So unless they make good decisions in the beginning, and having the right entity will help them tax-wise, maybe be able to claim a loss, maybe be able to also protect them in a way that if they have personal assets, they may want to have protected. So you have the basis sole proprietorship. Then you have an LLC. An LLC can be a single member LLC. In North Carolina, it's allowed. You can have an LLC that can be a corporation. You can be a single member LLC corporation. If you have two or more, you can have a partnership. You can have a straight partnership, or you can have a LLC partnership, or you can have a small corporation, what's called an S Corp, or you can have a regular C corporation, or you can have a professional corporation. There's various different, but the thing is, what's important is to identify, have a small business plan. What is your break even? At which point do you think that you will start to make profit? Is it 6 months? Is it a year? Is it 2 years? How much of investment is it going to take? What's the marketplace like? And so when you start to understand those thresholds, those limits, then you get to say, okay, well, let's take a look at this entity. Maybe a limited liability might be a good point to start, and then we'll push you over into a corporation when it's making money, and then you can pay yourself a salary. So there's different ways, different things to look at, but in the beginning, you need to make sure you get some information in there, small, even a couple of pages of a business plan, something that helps you identify your weaknesses, your strengths, your resources, and the limits to those resources, so the accountant or the attorney can help you plan with that and make sure that coincides with your goals. And in case the goals aren't met, the options are not as complicated or less complicated.
And as you were describing that, what brought to mind to me was if you don't think long-term in terms of how you establish your business and what type of entity, You can change that type of entity down the road, but that gets kind of expensive and difficult, doesn't it?
Not really. That's the thing. So let's say you decide because of risk mitigation purposes, you are an LLC, single member LLC, and you're running basically like what's called a disregarded entity. You're running yourself like a sole proprietor for tax purposes, reporting on Schedule C, but you have this protection of a legal entity called the LLC, that the bubble that kind of protects your business assets and your personal assets from your business assets, kind of two separate lives, and that's what you want. So you're running the business, and all of a sudden you say, you know what, I'm making more money now. I hate paying estimated taxes, or I have no control over. I keep getting hit with big amounts of taxes at the end of the year. Another option is let's make that single member LLC to be taxed as a corporation. Basically, it's almost a check the box thing. You file a form 2553. You indicate to the IRS that you want to be taxed as a corporation, and pretty much that's it. So there's no changes. You're still LLC for state purposes. That doesn't go away. But for federal purposes, now you have to act like a corporation. That's not. Now, it's very more complicated to take the corporation back, because you would have to dissolve it then into the, if you want to bring it back to the LLC. Or you can take that LLC to partnership. If you're going to have more than one, you can have your wife, you have other members involved, or a corporation. So it's not complicated. What really is complicated is knowing how to start and when to make that switch. When is it appropriate? When, because there's pluses and minuses with it. There's also another tax return. There's also rules and regulations now that you may not have been aware of, now that you got to be in line with and have to understand, so you don't get yourself in trouble as well. Right. So there are pluses and minuses, but there are benefits too with it, and that comes to guiding the individual. Okay, what is it? What are your strengths? What is it that you like? What are your weaknesses from it? Okay, then let's take a look at this option. Let's take a look at paying yourself a salary, so that rather than paying estimated tax every 3 months, where you might forget or you didn't pay enough, you're paying yourself regularly. If the company makes profits, we can take a look at other things there to reduce it. But that pretty much then puts them on a more steady diet of paying some money. And then there's also benefits too, as well. But as opposed to sometimes people wait until the end of the year, then they have to pay a big bulk, right, and it becomes a problem.
Gotcha. So why is it important to develop a good administrative infrastructure?
One of the things that I've learned over the years is that as a business owner, you can't do it all.
Right. And
one of the biggest problems, especially on the tax side, is that you could be running your business, you could be, the scary part, and you believe it or not, is you become successful.
Yeah.
Because then all of a sudden you are plowing full steam ahead with 10 things on the table, and the last thing you'll think about is keeping your records, keeping good set of records.
And that is so important.
It will bite you, and it will bite you hard, and you will learn a hard lesson. So initially, it's always good, get somebody part-time if you can, or make that time yourself every week to either get nowadays you can get an inexpensive accounting program, not difficult to learn how to use it, manage it, and also set up a good system of record keeping for the actual receipts and records, so that in case anything happens or you get audited, you have support. You're not just basing it on hearsay, on information that you thought you had or you assumed you had. People come in with a sheet of paper, these are my expenses and my income, and I tell them, I can't accept that, especially business owners. Once you become a business owner, you're put not only by the community, but also by the IRS at a higher level than a layman. They consider you more astute. A businessman is more astute than a layperson. So you can't just say, well, I didn't know.
Yeah, that's what I was getting ready to say. The IRS does not accept "I didn't know" as an excuse.
That is right. That is right.
So what initial steps should a person consider when they're receiving an IRS or state audit notice?
One of the scary parts because we do quite a bit of it, it's such a scary part for people. And don't get me wrong. If it happens to anybody, it is a scary process. But the point is to be prepared, to know you're prepared, to know that you're keeping those records, because when you don't know, you don't know, or you haven't kept your records, you know you haven't kept the records as good, then there is a lot of catching up to do. Now it's not impossible, but you have a lot more work that needs to be done to get to the point where it's presentable. The first things that you want to do is take a look at that notice. Don't ignore it. People do, out of fear. So take a look at what they're asking, what years they're asking for, what is it your personal, is it your business, is it what kind of records are they asking for? Now there's basically two types of audits. There's correspondence audits, and then there's audits that are right in your office. The correspondence audits are the ones they give you, send me your records, and you're not really kind of speaking face to face with one. And if you've got the records, it may not be as complex of an issue. If you don't have the records, then you need the guidance. The other ones that are more sensitive, because the IRS is putting the money in, bringing somebody to your office to review, to interview, to find out what you're about, and make the connection between what they found questionable on that return to what you're providing and what you're all about.
And they'll actually come to your office and look through your records?
Well, yeah, of course. Well, you either that or you provide them the records. But yeah, one way or the other, they're going to want to see actual records, supporting records of whatever expense. If you have a Schedule C, what do you have for your materials? What do you have for subcontractor expense? What do you have for supplies? You called, you got $20,000 in phone. Let's see, but when it comes to the point that somebody is going to come to your office, or come to if you have a representation to your representative's office, what's important as well is that if you decide to take the audit on your own, make sure you have your records, make sure you're prepared with the information. But at the same time, make sure that you only answer the questions you're being asked and not more.
Okay. All right. So let's say a person's being audited, the audit is finished, and the person does not agree with the findings of the audit. What do they do? Okay.
One of the important things that have come out in the last few years from the IRS is given individuals what's called the Taxpayer Bill of Rights.
Okay.
In the Bill of Rights, there is an element there that allows people to, one, disagree, question the auditor, request the supervisor of the auditor if they feel that the auditor is not one something they can work with, or seems like it might be overly aggressive. But you have the right to appeal.
Okay.
And you have certain number of days that given a notice to appeal that decision, so that you have a second bite in the apple to present it to a group that's independent from the auditing department of the IRS. They will look at the facts and the rules of the law and the documentation and see how that may better fit, if it does, for you. But the other aspect that's important too is the IRS has another separate department called the Taxpayer Advocate Service, which if you feel that you're being put in the position financially or that it might be a situation where you feel that could be hurtful to you economically or otherwise, you can call them. There's a form 911 to request, and they will determine whether they can provide that service to you based on the application. But that's something that's also very valuable that we've used in addition to make sure that there's a balance between the audit, the aggressiveness, if there's any, and the other aspects that could help the taxpayer as well.
All right, well, let's turn the tables a little bit. Let's say the audit is finished, and I agree with what the auditor found, but I just simply cannot pay this proposed amount. What then are my options?
And this happens quite often because some of those audits are basically pretty straightforward in some ways. You just, there's some numbers really that really didn't make sense, and it was found. So all of a sudden you have a tax liability that jumps thousands of dollars, and then there's penalties, and then there's interest, and that's compounded daily. And then there's also the likelihood that what happens at the federal level, the state will be notified, so you'll get bitten twice as well. So that's why it's so important to make sure you address the audit as carefully and as much as possible to reduce it as much as you can, because you're going to get whatever is due, you're going to be bit twice. So now you've got a liability that is beyond your financial resources on your day-to-day living or your business and your business operations. So you can consider establishing a installment agreement. But the installment agreement, you also want to be careful in that they may want more than you can afford on a monthly basis because they want their money. But there are forms that you can fill out, 433A or 433B, depending on if you're self-employed or an individual or a business, like corporation and such. And you can provide all your information or your assets or your debts or your income, your expenses in the last 3 months, an average. And that's another way to determine what you actually can pay. Okay. Maybe they want $800 a month, but there's no way because they want it paid off within a certain statutory period. But I can't pay $800 a month. I can only pay $400 a month. But then going through the financial analysis, it will be a more realistic determination of what you can afford. And then that is a good way to establish a path. Now you may be paying a lot, or you may not be able to pay it at all, because there's a 10-year statute of limitations. So it all depends, but the IRS has a right to go back and review every so often your finances if it's too low. The other option, if your resources are so, or your financial situation is such that you'll never pay it. This is way out, and that your current situation and your future situation economically is not going to grow. It might even reduce. You might be in your later years in life, or your health may not be good, or might be deteriorating, or there might be other issues that will affect you economically, and you know it. There's also the offer in compromise. The offer in compromise is another way to try to settle in full based on calculated amounts of what you can offer to them, and then that would then, if accepted, you have to maintain good compliance for the next 5 years, and after that, then your record would be clean. That liability would completely go away. But it's not so easy. There is probably a 10 to 15% success rate. So you're talking 80 to 85% of the people that apply don't get it.
Gotcha.
You see a lot of people offering, will pay a few $100s, a few $1,000s on a $500,000 or $1 million. Depending on the situation, sometimes, but you can't control what the IRS will decide, and you can't tell someone, yeah, we can get you saved. So there's a lot of falsehood out there, but there's a lot of opportunity too under the right circumstances to help people right size their ship with it.
And the key thing is as a business owner, you need somebody who is an expert in dealing with accounting and tax issues to help you navigate through those options that you have so that you know what are your better options. It takes a lot of experience and expertise for that.
It does take a lot of work. One of the things that's always a challenge for us in the industry is the ever-changing tax code. Mm-hmm. The procedures that the IRS does is pretty straightforward. They put it out there. They tell you how they're going to act, how they're supposed to act. I think a very important aspect of this, and it really is, we're dealing with people's lives, really,
right.
Their financial lives, which in turn becomes their personal lives, which in turn becomes a complex aspect in it. And so, yes, there's plenty of us out there that do a good job, but make sure that you find somebody reputable, because we see enough of people coming in with the wrong guidance, the wrong maybe guidance is the right word, but it's just they're just not given a good direction,
Yeah.
and all of a sudden, when that bottom falls, they're in a very tough situation. So yes, somebody with knowledge, and somebody also that you want to do a little checking. You want to ask others. Most of my business is referral based, so you want to talk to somebody who's experienced it, and somebody who's helped them, or somebody they trust, because we're dealing with a very sensitive part of people's lives.
Well, since S corporations are very popular among small business owners, what do you consider some key issues to consider when you're initially setting up an S corp?
You know, S corps have been in this last decade very popular for small business owners for a number of reasons. But there's a number of aspects or issues that keep cropping up that people are making the wrong decisions with it. Number one, it's a great entity for many reasons, but it is a legal entity. It is a corporation. Nonetheless, that means you got to make sure you follow the corporate dictates, taking minutes, making sure that you document any major decisions made by the corporation, and not just, yes, I made the decision of becoming an S corp. I made the decision of investing in this new business, but I never incorporated that in some document that says I, as the board of directors, right, gave you authority, me as president, or however, have an attorney involved to help you. Sometimes it doesn't cost very much. An attorney will help you maintain those annually the records, and can save the individual a lot of headache. You have the benefit, the legal benefit, but you got to have the legal compliance. Right. So make sure you work with your attorney to set it up. Sometimes people set it up on their own. That's fine, but get the guidance wherever you got it from to make sure you're keeping that legal compliance correct and up to date. That's number one. The other aspect that we see, and which is a no-no for most of us, is people in the real estate industry. It happens sometimes that they will have the corporation buy the real estate property and put it and house it in the corporation. The problem with that is that you're going to get taxed twice on that because it's appreciated. Any property that appreciates in value, you don't necessarily want to put it in the corporation because the only way you're going to take it out is going to be at fair market value. So you buy something at costs you $10,000 and you're working it and you made money. All of a sudden, you realize, okay, you know what? I'm going to sell it and give some of that money to my son or family members. But all of a sudden, it ballooned up to $60,000 and there's a $50,000 gain. Now, you're going to have to pay that gain as you distribute that property gets distributed to you. So you're going to be taxed on that coming out of the corporation. Right. So that's why it's good to put rental properties in an LLC separate from a corporation. Corporations runs the business but doesn't house real estate or anything in appreciated property. Commingling of assets. You have a corporation, do not pay your personal expenses out of the business account. It happens sometimes, but don't make it so obvious, so bad, that it becomes a significant part of the business. One of the complex aspects of S Corps, and as well in line with partnerships, is having a basis. It is what the shareholders' basis is, has to be maintained. It is a determination, the calculation is done every year, and that determines whether you can take a loss or not. Just because you have a loss in the corporation doesn't mean it's automatically deductible on your personal return. You've got to have sufficient basis to be able to claim that. And sometimes people don't think about that. You'll see returns that have losses, and you say, well, where's the accountant's work on the basis determination? Well, what's that? So then you got to go back, okay, you've been in business now for 5 years. We got to go back and calculate what your basis is, going back to the beginning from your initial investment, money you took out, losses, profits, all that could get, and if there's loans, there's also other calculations too with loans if you lent the corporation money, which sometimes happens. Right. But if you take that money back before the loan is paid in full, you have some capital gains to deal with that some people don't do or report. And so it is complex. It is something that you can reduce your taxes in S Corp, but there's quite a bit of compliance that you've got to stay above.
Well, as a business owner myself, when others are talking about possibly starting their own business, what I advise them is get a good lawyer and an even better accountant. And I think that's still very true. George, thanks so much for sharing your story with us and sharing these really important insights. And if you want to know more about George Navarro and his business, please visit his website. The address is at the bottom of this page, and it's also at the end of this video. George, thanks again for being with us, and we wish you great success.
Well, thank you so much for having me, Ken.
Thanks for tuning in to Piedmont Business Live. We'll see you again next time.